Global headlines over the past week warn that a single strike or disruption in the Gulf can ripple across crude benchmarks, fertilizers, and farming supplies. Iran remains a central piece in a volatile energy mosaic where even rumors move futures and farmers adjust budgets before planting. The question today is not just about oil flow, but about fertilizer nitrogen, phosphate, and aged commodities that depend on stable energy, navigation routes, and supplier confidence. Investors watch yield curves, port bookings, and refinery outages as if they were weather reports because a single disruption changes costs from field to pantry overnight globally. Late-breaking developments intensify the risk that oil flows through the Persian Gulf could be constrained, forcing traders to reprice risk and producers to adjust guidance. When tankers pass through Hormuz, even a weekend flare-up can tighten supply expectations, lift crude benchmarks, and push refinery margins higher. At the same time, fertilizer markets hinge on energy costs because most ammonia and urea production runs on natural gas or coal. A disruption in crude or gas feedstock can raise fertilizer prices and, in turn, raise costs for farmers who rely on synthetic inputs to plant corn, soy, and wheat. The ripple effect travels quickly across ag chains. To understand the stakes, consider the Gulf Energy Corridor and the fertilizer supply chain that threads through energy markets, shipping lanes, and state actors. Iran has long leveraged its energy assets as bargaining power, while global buyers diversify away from single suppliers. The 2010s saw sanctions squeeze Iranian crude, boosting Brent volatility and incentivizing alternative supply routes. Fertilizer dependence binds farmers to energy costs. Natural gas prices in Europe and Asia directly affect ammonia and nitrate production. Historical episodes show how sanctions, ship attacks, or political risk premiums can push prices higher for months, reshaping hedges, budgets, and investment plans across ag value chains. Commodity markets are pricing risk into every layer of the supply chain. Brent crude hovered around the mid-80s to low 90s this week, while WTI traded near $80 as traders weigh risk premiums and potential oil shipments blocked or rerouted. Fertilizer futures, including urea and DAP, jumped on anticipation of tighter gas feedstock and volatility, with urea futures up more than 15% versus a month ago. Airlines face higher jet fuel costs, farmers face tighter inputs, and chemical distributors adjust inventories. The real effect shows up in fertilizer cash prices, freight rates, and seasoning schedules near planting windows. Industries feel the heat from multiple angles. Oil majors with Gulf exposure see capital discipline tighten as futures swing. Producers must hedge and plan capex with higher risk premiums. Fertilizer players such as Nutrien, Yara, Mosaic watch gas contracts and regional demand, while farmers adapt budgets for fertilizer and energy costs near planting season. Shipping and logistics firms face higher insurance and fuel prices, potentially delaying shipments. Investors in commodity funds, producers, and seed companies recalibrate portfolios. Retailers and farmers face cash flow pressures if input costs rise before harvest. Banks and insurers reassess credit for energy and agriculture projects. Geopolitics and macro trends frame every move. Sanctions, naval posture, and alliance shuffles can widen risk premia, while OPEC-style production discipline can cap price volatility at times. The dollar strength versus emerging markets affects pricing, debt service, and import costs for fertilizer and machinery. Energy diplomacy influences refinery runs, gas allocations, and power generation across Asia, Europe, and the Americas. Global inflation and supply chain bottlenecks amplify price swings, encouraging hedging and diversified sourcing. In short, a regional flashpoint becomes a global price dial, tugging on freight, credit spreads, and agricultural cycles long after the initial headlines fade together. Smart money is adjusting portfolios toward resilience. Banks and hedge funds push longer duration energy hedges, while buyers rotate into refined products and timing spreads that benefit from backwardation. Exchange-traded products tied to oil, fertilizers, and ag inputs have seen inflows, even as equities in energy services climb on speculation of tighter supply. Producers hedge more aggressively, locking in prices for planting and capex cycles. Retail investors look at fertilizer ETFs and energy funds as leverage plays, yet they also diversify into agro stocks and fertilizers with visible earnings catalysts. The net effect is higher risk awareness and calibrated exposures across risk profiles. Bear case scenarios remind us that headlines rarely stay contained. A prolonged escalation could close Hormuz or force alternate routes, unshackling supply fears and pushing Brent toward triple digits. Sanctions miscalculations may hamper Iranian crude more than anticipated, redirecting supply to clever circumvention networks and increasing compliance costs for buyers. Fertilizer markets could spike further if gas markets spike, or if global crop demand remains resilient, squeezing margins for farmers and processors. A liquidity shock or credit tightening could trigger margin calls, forcing selling across energy and agriculture equities. In short, unseen feedback loops can amplify risk quickly and unexpectedly. Retail investors should respond with calm, not panic. Start by sizing risk before chasing headlines. Set a max allocation to energy or fertilizer exposures that aligns with goals and time horizon. Use diversified strategies such as broad commodity ETFs paired with quality growers or chemical suppliers rather than concentrated bets on a single name. Emphasize hedging, not speculation. Rolling covered calls on a fertilizer ETF or buying put options can limit downside while staying exposed to upside. Maintain cash reserves to withstand volatility and monitor leading indicators like shipping rates, gas prices, and planting windows. Finally, avoid over-leverage in volatile markets. Looking ahead, the Iran flare-up remains a wild card that could accelerate already rising energy and fertilizer costs, while supply routes adjust to new risk landscapes. If risk premiums stay elevated, farmers may plant more conservative crop mixes, sharpening rotations and tightening fertilizer demand signals in the next season. Smart buyers will watch energy load factors, refinery maintenance schedules, and gas price moves for hints of fertilizer margins. For long-term exposure, consider inflation hedges, diversified commodity equities, and quality producers with solid balance sheets. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.